My distinct pleasure now to introduce you to the first speaker, a former colleague of mine, Jim Gaines, who retired, but it didn't take. We've got him back here this morning to give you his view of the economy and tell you a little bit about what we're looking at this point and maybe what we can anticipate in the future. So please welcome Jim Gaines.
Good morning. How are we all doing? I know that this is the most exciting thing you can do at 8 o'clock in the morning is have to sit and listen to an economist. So I hope I'll try and not put you back to sleep again. But you can probably have that cup of coffee and enjoy yourself. We've got an interesting program going for us today and tomorrow. Let me go ahead and get started. And what I'm going to do is try and give some outlook on what's going on nationally and at the state level, a little bit about the housing market, and then our outlook for the coming year or two in terms of activity, general attitude, and the economy going forward. I'm going to go ahead and start and tell you kind of what's happening right now, what we think is going to come, and talking about the economy and the recovery, which is going to be a word that you're going to hear over and over, I'm sure, in the course of the next couple of days. The economy is looking at more jobs, more income, more consumption to have any kind of chance of getting back to where we were more or less back in 2019, which was the last year of quote unquote normal times, if such a thing exists. Everything is going to be conditioned. Every projection that you're going to hear from anybody, particularly about the economy, but everything is going to be predicated on getting the COVID impact under control and the COVID pandemic under control. The vaccination program is going on. We've had over 200 million vaccinations applied. We're still nowhere near, though, at a national level or at the state level, achieving what is called the herd immunization to get over it. So we're not there yet. Economically, just in the last 4 or 5 months, we've had nearly $3 trillion dedicated to fiscal stimulus. I think stimulus is a little bit of a misnomer for what we've been doing and dating back into last summer. With the original packages that were prepared. It wasn't so much stimulus as much as survival, and we're seeing that. Then on the other hand, we've got the prospect of having somewhere between a $2 to $3 trillion infrastructure package that may be adopted by Congress sometime this year, probably not go into full effect until next year. That may help fuel some of the recovery as well. Most of you are probably well aware that the Fed is still keeping interest rates low. At their last meeting just a few weeks ago, they announced that they were going to keep interest rates as low as they possibly can, and they don't foresee, at least this year, having to raise rates. I think they're going to find that's going to be harder to do as we get into about the fourth quarter of the year. For the next 6 months, it won't be that bad. But by about the fourth quarter, that's going to be a little bit more difficult. We'll just have to see how that's going to run. One of the things that's been fueling, though, the recovery that we're having is increased household spending. For those of you who have heard all these economic presentations before, you should be well aware that our spending of money, household spending, corporate spending, government spending in total, but particularly the PCE, the personal consumption expenditure, accounts for about 2/3 to 70% of GDP. So getting all of that out, getting people out, spending money, fiscal stimulus, pent-up demand, savings. The savings rate for the past year has been astoundingly high. The U.S. normally has a savings rate. We're not real good savers. We save at a rate of about 6 to 8% of our income a year. That rate has been as high as 33% during the third and fourth quarter of last year and going into this year. So a lot of pent-up savings, pent-up demand going on. What we're going to see is a lot of short-term inflationary pressure, particularly here in the next 6 months as we start reopening the economy. Texas has been a leading state in that from a state perspective of reopening businesses and restaurants and so forth. And we'll just have to see how that's going to go. Yield expectations and requirements are mounting fast. Those are going to be pushed, particularly by inflationary expectations, and those are going to start affecting asset prices, particularly real estate. And that's real estate of all kinds: land, housing, commercial real estate, industrial real estate, and what have you. So it's going to, that's what we're looking forward to. It's going to take most of 2021 to get there, and then we're going to get into 2022 when a lot of those expectations come about. Here's what GDP, that's our measure of growth. Of course, you can see the little blue bars there to the left. This is how it's been going for the last couple of years. Relatively slow but consistent growth. Last year, 2020, the U.S. total, it was the best of times, it was the worst of times, to quote somebody from history. During the second quarter, we had the worst on record recording of annual GDP change, the negative 31.4% you can see on the graph, then followed in the third quarter by the best quarterly growth, annualized percent growth in GDP at 33.4%. If you're aware, though, of the way the arithmetic works, if you go down 30%, you've got to rebound almost 60% in order to break even. So the 30, down 30, up 30 doesn't exactly break you even. Fourth quarter, we did manage to get a positive growth rate of about 4%, a little over 4%. Best guess for first quarter, best guesses, and incidentally, I should probably have started this whole presentation by telling you that no economist in the world really knows what the heck is going on. So I'm no different. So you can now turn it all off. But the problem is we've never gone through a period like this before, where we've had the shutdown from a pandemic and so forth, and then tried to reopen not only the American economy, but the global economy. It's everywhere. Best guess for first quarter growth is somewhere between 4 to 7%. I put a bar up there calling it 6%, kind of splitting the difference. Last year, US declined 3.5% on an annual basis. And you can see how that compared to like UK, France, Germany, some of the other economies. It was a really, really tough year. I said that everything hinges on getting the COVID under control. Here's what it looks like. This is data from the CDC. These are 7-day moving averages. So it's not the daily rate, it's a weekly, if you will, average rate, averaging the daily. The good news is you can see the real drop off from what was happening at the early part of last year and then through the summer, and then the early part of this year in January, where we had the peak caseloads being reported. The death rate also has been coming down. This is good news, although that blue line has kind of trended back up again here lately. That's some of those new variants and cases that they're finding around the country, including here in Texas. So we'll have to watch that. The good news, of course, is death rate trending downward. It's still not under control, whatever that would mean anyway. So we're still waiting to see how that happens. As you all have been watching the data, weekly unemployment claims ballooned back in March. About this time last year, March and April of last year. We're a year into it now. This is the U.S. weekly. Those little black bars over to the left on the far left-hand side of the slide, that's what quote unquote normal looks like. Our relative normal rate of weekly unemployment claims ran between 200, 250,000 claims a week. We've been running multiples of that, anywhere from 4 or 5 times. Right now, we're running about 3 times at about 750 on a weekly claim basis. Unemployment rate has come down to about 6%. Some of that is helped by the fact that we've got more or less permanent unemployment going on. We still have nearly 17 million people, though, with continuing unemployment claims of one type or another. There's about 3 or 4 different programs, including pandemic relief and so forth. And this is sort of that grand total that it goes up to. Recovery is not going to happen until we get back to about where we were in terms of total number of people working. And this graph shows you that back, this is our year over year almost from February of last year, which was the last month data at pre-pandemic levels. And then compared to March here this year, we're still down a significant number of jobs, about a little over 8 million jobs, almost 8.5 million jobs. You can see that this is what an economy looks like when it falls off a cliff, that rate of decline from January to the end of April was just a tremendous decline. Almost over 20 million jobs lost in April alone. We bounced back, had that sort of V-shaped, semi-V-shaped recovery. We're still 8 million jobs short, still not there. The trend is in the right direction. It's going to take the rest of this year at least to get back up to just where we were back in February of 2020. Small businesses, the optimism index, if you will, this is a composite index from the National Federation of Independent Businesses. You can see here, it's been very erratic. It fell off very, very much, of course, last year, no doubt about it. Small businesses hit very, very hard with the pandemic. A lot of the small businesses, of course, were forced to shut their doors and probably will never reopen. Best guess, somewhere in the neighborhood of 500 to 700,000 businesses nationwide probably went out of business this past year in the course of the last 12 months. And the issue is, will some of these be reopened or reformed, restructured, and come back into existence? Good news, you can see right out there on the tail end, it's beginning to pick back up some optimism as we try to recover and come back up. Here's one piece of good news. We haven't stopped buying things, physical product, retail sales of goods, that's physical commodities, if you will, has rebounded, and you can see is well above the long-term trend line, the dashed red line in there. And you can see that has done, it had the V-shaped recovery, severe drop-off back in April of last year, immediate recovery by the summer, bounced around, and then here in the last, mostly this year, you can see it's accelerating even fast. The problem has been on the personal consumption expenditures is that spending for services, all kinds of services, any kind of services, particularly for any kind of service requiring in-person activity, like daycare centers, healthcare centers, spas, gymnasiums, those kinds of activities, that spending has not recovered and is roughly twice the level of goods spending. So what you can see here, much like the employment growth or recovery, is still significantly below where it was, about 5% less than the pre-pandemic level. That's the area in which we are looking for recovery here over the course of this year as some of these businesses start reopening, restaurants and bars and all kinds of other kinds of personal services activities that may come into play. That constitutes a significant portion of our total economy that we're looking for coming back. Well, that's kind of what's happened at the national level. Obviously, the federal government has been trying to pump out money. It hasn't happened. You can see the spending there was up on goods. People are still buying things, buying groceries. That's still food, but they're not going to restaurants and buying things, but not buying the services. Some of that has to do with the turnover of money and so forth. Texas, let's turn our attention to Texas. As all of you are well aware, Texas last year got hit with a double whammy. It actually started pre-pandemic. It started in December of 2019, January of 2020, when Saudi Arabia and Russia decided to have a price war, and the energy market, particularly the price of oil, collapsed completely, a great deal, and started an energy cycle decline that affected the U.S. energy market. And of course, that means it affected Texas in a great deal. That happened. And then about 3 months later, starting in March and then into April and May, we get the pandemic whammy. Whammy is one of those technical economics terms that we like to use from time to time. Anyway, we got both of these coming and hitting the state and the country, particularly the state, at the same time. It has caused some uneven recovery, uneven economic consequences around the state. Some areas doing much better than other areas, particularly the areas that were not as tied to the energy sector as others, were not hit as much, of course, by the energy decline, but everybody got hit by the pandemic one way or the other. Here's what it's going to take for Texas's recovery. And again, everything is dependent on COVID control and getting the pandemic under control. So everything starts with that, ends with that. If we don't get it under control, and I'm not sure what under control means. I've said that now. I'm going to say it probably 6 times so you'll remember it. But it has to look like something else. Reopening our economy in Texas, and Texas was one of those leading states where the governor announced easing restrictions, opening up businesses, opening up schools, and so forth a little sooner than some of the other states. Right or wrong, good or bad, doesn't matter. It happened that way. We've been reopening the economy. It's still going to take some time. It's going to take months. It's not going to happen overnight to have the economy come back the way we would like. Job recovery is happening. We're anticipating some pretty good job recovery during the course of the year. We didn't start the year too well. January, February almost broke even. February, of course, was such a weird month because of the weather. So we didn't get the job growth in February that we were kind of hoping for, and it balanced out. It kind of offset what we got in January. March is coming pretty good. I'll show you. You know, I'm an economist, so there's graphs and charts coming here in a minute. But people are being brought back. Here's the sense. We need all these people who got laid off and who lost their jobs to come back, be brought back in, get new jobs. One of the issues that's been interesting here in the last 3 or 4 months, particularly with the latest round of fiscal stimulus and unemployment benefits, additions to the unemployment check, is the willingness of some of the people to come back to work. It's no secret that for some people, they're probably making more being unemployed than they ever made when they were working, particularly at some of the lower income jobs, lower paying jobs, that kind of thing. And we're hearing all kinds of reports of businesses now trying to reopen and come back and having real problem in finding employment. It's interesting to hear Phil talk about capital Farm Credit is hiring. A lot of companies are now hiring. There's actually a surplus of jobs available relative to people unemployed. Other things that's going to take for Texas recovery: consumer attitudes and spending. We got to be willing to open our pocketbooks, get out, buy things, buy services, get back into the swing of things, if you will. Texas, like the rest of the country, we have a lot of businesses that either had to shut their doors temporarily, or unfortunately, some probably went out of business altogether. One of the things we're looking for in the course of 2021 and on into 2022 is going to be the spirit of entrepreneurism, of people reopening businesses, opening new businesses, and getting out and providing the goods and services for people to do. It's going to be a combination of things. Banks have got to be willing to make business loans. people have got to be willing to take the chance and go into business. The energy market is going to be interesting. You're going to hear more about that in the next session. I'm going to touch on it a little bit here this morning. The energy market, we're not looking for it to be a driver as it has been in the past. What we are also expecting is that it should not be a further deterrent in the economics of the state and sort of be neutral. A few jobs might be lost or gained, but it probably won't be the driver that it's been in the past, nor will it be the maker of breaks and so forth. Housing right now is, of course, the strong part of the economy. Nationally, it's extremely strong here in Texas. I'm going to touch on the housing market a little later. This will be our time to talk about that. And then lastly, state and local government budgets have been affected and hit hard by the pandemic. It's going to take at least the next biennium for the state to have a chance to come back and reestablish itself. We're going to see it happen at much at the local level. Employment at the local level, the level of services provided, the timing of services, the quality of the services provided. You're going to have some patience here for local governments, and everything is going to be a battle in terms of budgets and budget constraints. Trend in the COVID in Texas, we've been trending like the US. The trend line is very good on that blue line. The number of cases being reported, this is through CDC again, coming down. A little bounce back there in death rate. I suspect some of that is a data collection issue as well, because they actually reported a few days of 0 deaths statewide, and that may be an issue with the data. But we can see that both the new case instigation and the deaths coming down. So at least we're moving in the right direction. I think the state has an inoculation rate of about 25% was the latest data that I've seen on that. We need to get that number up significantly and get the vaccinations out and get that herd immunity going for everybody, mostly to just simply feel more comfortable, to feel more confident. And that'll be part of that consumer attitude of being willing, able, and feeling good about going out and being economically active. You can see that we've had in continuing unemployment claims in Texas. It picked up a little bit the last month or so. I can tell you the report, I think this came out yesterday, there'll be another red bar out there on the far right that is significantly lower than the 3 or 4 there that look like a little bit of a peak. So we're still going out that way, but still, even at that, there's over 300,000 people still claiming unemployment insurance here in Texas. You can see, again, much like the national statistics, the little black bars over there to the far left, we ought to be running somewhere, anywhere around 20,000 jobs, 18 to 25,000 claims a week. And instead, our claims have been running anywhere around 75 to 80,000 a week. When we get that back down into that under 25,000 level, then we'll have a pretty good indicator that the economy, and particularly job creation, is now catching back up to that pre-pandemic level. Much like the national statistics, job growth and employment growth here in Texas, we had a falling off the cliff from in February of 20 down through April, and then a bounce back, kind of leveled off. Again, that February number is out there. They haven't officially posted March yet, but the estimate is it's about 100,000 jobs gained for the month. So that's going to move that orange line back up the scale a little bit more. But February to February, which is basically one full calendar year, if you will, of being in the pandemic, we ended the calendar year down just shy of 6% in jobs. We're down about 775,000 jobs or employed. This is employment. This is employed people, people working. And it's going to take a while to get that all back in. One of the things you see here is that by industry, every industry during the course of this pandemic year lost jobs, with the exception of transportation, warehousing, and utilities. It was the only industry that by February 2020 had actually exceeded by February 2021 had exceeded the February 2020 data point. And everybody else was down. Leisure and hospitality, no surprise. The big loser there, 205,000 jobs. That's all the restaurants, the bars, and so forth. Mining and logging, of course, the double whammy of the energy decline on top of the pandemic. Also significant job losses in terms of percent change, the biggest loser in terms of industries. By area of the state, these are the 25 MSAs in the state. And the thing I would point out to you is that all of our major MSAs and the surrounding counties, the metropolitan areas of those, every one of them lost jobs. The good news, if you will, for a lot of you in the audience is that a lot of you come probably from areas with micropolitan areas. These are the counties that surround an urban center of 10 to 50,000 in population. They actually had a slight gain in jobs and people working. So as you know, they weren't hit nearly as hard as the urban areas where people were more exposed to each other. This is the Real Estate Research Center's weekly index. If you're not familiar with it, it's available online on our website. This is the one from April 12th. And what you see is that slight decline out there on the far right. The real reason for that was the February weather. And I think what we'll find in March going forward the next few weeks, that weekly index is going to start picking back up. This is our leading index on a weekly basis to give us some idea of what to expect in the short run, in the next few months, in the next 3 to 6 months. And it has been pretty accurate measure for that. I said I'd touch on the energy market. I don't want to steal thunder from Dr. Hollerman coming up behind me. But this is, we're all aware that the price of oil from January of 2020, when it was up at $61, it fell down. And in fact, in April of last year, actually one day went negative for a few hours, where producers were literally having to pay people to take the oil off their hands. The rig count fell accordingly following the price declines. What we see, though, is a very interesting pattern here that today we see that the price of oil has gone back up to that pre-pandemic level. And in fact, in the last week or so, in fact, the last month or two, has been hovering in that 60 to actually 58 to about $64 a barrel range. It probably isn't enough to get drilling and rig activity back up to the levels that it was several years ago, but at least it'll be level. And that was where I was basing the comment earlier, that we're looking at the energy sector from an overall economic perspective to the state to be more or less neutral, be good, not bad, not great, not a driver, but doing pretty good. So it's been an interesting rebound on that going on. The Dallas Fed, of course, as many of you know, puts out a leading index on a monthly basis. They have shown a more or less V-shaped type of recovery. The February number was back up around 120. And that's just an index number. It's not 120 of anything, it's just an index. But you can see the pattern there, that the economy is a lot more optimistic in terms of where we're going. This is a leading index that generally is more leading for on a 6-month to 12-month basis of where and the direction of the economy in general. Here's the interesting thing on employment. We are looking that by the end of this year, when we look back and look at the total for 2021, that job recovery will probably come back up to about the 2019 level. It may not completely, it's really problematic right now. Best guess This is not a prediction, it's a best guess. Looks like we might expect jobs to come back up about 6%, somewhere between 5 to maybe 7.5. I've used 6 here on the chart. It would, on an annual basis, we'd be back at about pre-pandemic levels. You can see the fall off there for 2020. That was no surprise. Down over 4%. Total of almost 550,000 jobs lost. A gain of a little over 700,000 jobs, hopefully this year. We've got a long way to go. Most of that gain is going to be in the second half of the year. We've expected that all along. We knew the first half of 2021 was going to be relatively slow. The second half was going to pick it up. Let me turn some attention to the housing market. The housing market's been getting a lot of attention nationally and here in the state. I know everybody has been talking about it. There's been so much activity going on, and it has been basically the only industry that has had strong economic growth during this entire pandemic period. Once we got through April and May of last year and got into the summer months of 2020 and then moving forward. Incidentally, one word of caution, all of the percentage rates of change, year over year numbers and so forth for the next few months are going to be very misleading because everything was so bad a year ago and is so good this year. Some of the percentage change numbers are going to look exceedingly good. Here's what's going on, and this is kind of what I expect to happen not only this year, but moving on into 2022. And this is no particular order. These are the kind of things that are influencing the housing market. The demographics, the millennials that we've been talking about for the last 7 or 8 years are looking for space. Many of them are first-time buyers. A lot of them who got sheltered in place in 700 square foot apartments are now looking to get out of those apartments. Also, they're getting older. That age group, the millennials, one of the things they've discovered to their chagrin, and they can't do anything about it, is they're getting older. And now we've got a significant number that are between 32 and 40 and getting married, having families, and getting out. The other group here on the demographics, I didn't put it up here, but it's Gen X. The group right between the millennials and the baby boomers. A lot of them are people who have kept their jobs, have significant savings, and are moving up, if you will. And it's one of the interesting factors leading into the distribution of sales. High-end property sales have caught on the last year and have almost doubled in terms of market share, causing some of the statistical anomalies we've seen. Other limited inventory, especially in key price groups, the higher price groups and the lower price groups, very short inventory. Statewide, we're running about 1.4 months. In Aggie speak, we ain't got any. And in some of the major areas like Dallas, they're running even less than that, and Austin running even tighter than that, which is leading to the higher prices, which is creating affordability issues, particularly price levels relative to incomes. The rate of increase in some of the prices is not sustainable over a long period of time. We've got to be very careful about that. Interest rates are still low. They probably less than 3% is over, but will probably not be much more than that during the course of the year. I'm looking for 3.25 to 3.5, maybe by year's end, something on that order. The ease of mortgage financing, how willing lenders are to make loans. It's getting harder. I'm going to show you a chart here, the next one in a minute, from the mortgage bankers. Lenders are beginning to get a little nervous of how strong the housing market is, the price increases going on, the potential of a decline at some point in time, or just even a leveling off, which is inevitable. And so the ease of getting mortgage financing, higher FICO scores, more credit rating, higher down payments, that thing, those kinds of things. The technology is allowed for online sales. It's been forced on us during the last year. That's not going to go away. We're going to continue to see the technology involving the real estate industry, including the land markets, using technology more and more and more for the way that properties are marketed, the way the closings are happening, the way negotiations are conducted, and so forth. Increased wealth, if you've been following the stock market, of course, it went up again to over 300 points yesterday. It's been record highs here for the last few minutes. We're going to have to see how that goes. Real estate has also become a major target for investors. That is forcing some of those prices to go up and is going to come up again. Here's what I was talking about, the ease of financing. This is the Mortgage Credit Availability Index from the Mortgage Bankers Association. You can see how that's dropped off, trying to trend up a little bit, but they're being a lot more cautious. We're looking for home sales next year to go up about, this year to go up about 8%, home prices to go up between 8 and 9%. You can see it's going to be another record year. Home construction is not going to happen yet. It's really going to be an interesting phenomenon. What I was going to show you here is that the cycle that we went through back in the 80s, from 82 to 1999, took 16 years to recover. If we achieve our forecast for this year, it'll be 16 years from the prior peak. The Texas Residential Construction Index, which is something we produce here, is online. You can see the green line is showing us rapid growth. Housing construction permits are up for everything except multifamily. Major areas, major MSAs, single family permits are up. Here's what some of the builders are doing to try to alleviate some of the COVID boredom. They have come up with some amenities for the houses to help people that have been shut in for so long. You can see that Austin, Dallas leading the way in terms of median new price per square foot issues. Demand influences, we've had a pandemic effect that's really working its through. It's the way, where and how people are working, space needs, people are looking for location, moving to the suburbs. The demographics are coming, particularly that 26 to 40 age group. First-time buyers are now a record 43%. Individuals as well as couples. The economics, the jobs and income, low interest rates, higher savings rates are all pushing the demand. Supply is limited. People are simply not selling. The turnover rate has slowed down. Limited supply of new homes. We are building homes now at almost record levels, but it's still not enough. The availability and cost of labor has been a major problem. Also, recently issues with material costs and delivery, the supply chain being blocked up. It just came out this morning. Lumber prices are now at $1,300 per 1,000 board feet. That's up from $250 a board foot a year ago. So it's telling you what's going on. Here are our projections for the single family housing market for the state. You'll see that every market is projected to do extremely well in new construction, in sales, and in price gains. Texas is going to continue to grow in 2020, just like it did in the 20-teens, but probably not as fast. Our business climate is going to be subject to numerous effects, political, social, demographic. That political is taking what? The entrepreneurial spirit is going to be critical in getting business back and going. I'm forecasting that 2022 is going to see the real fallout of the pandemic. Because of moratoria on evictions and foreclosures and bankruptcies and business failures, a lot of that isn't going to come into play until next year. So it's going to be something to watch out for. There's going to be a major repricing in commercial markets as interest rates and inflation expectations are affected. Housing and land, though, are going to remain strong investor avenues and create more imbalance between demand and supply. I appreciate your attention. I know we have a few minutes left for some Q&A, and we'll see if I can answer any of your questions in the time remaining. Thank you.
Good morning. I'm Brian Pope, Managing Editor here at the Texas Real Estate Research Center. Just as a reminder to those of you who are new to this platform, if you want to submit a question, all you have to do is click the blue. Good morning. My name is Brian Pope. I'm Managing Editor here at the Texas Real Estate Research Center. If you'd like to submit a question, simply click the blue Q&A a button on the right of your screen, and then you'll see a maroon bar that says ask a question. Type in your question, submit it, and we'll pass it on to Dr. Gaines. In the meantime, a couple of people have asked if the presentations from this conference will be available for viewing afterward. And yes, they will be posted on our YouTube page at some point soon after the conference. So look for announcements of that on our social media channels. And if you're a subscriber to our Recon newsletter, you'll see it there. We'll be sure to get the word out to you. Again, if you have any questions, you can use the blue Q&A button on the right of your screen.
I'm ready for you. Shoot. We'll see where we can go on. Like I said earlier, this is unusual time for us. And so trying to estimate what's going to happen and where we're going and how fast we'll get there is really difficult. I really do appreciate your attention this morning, and I wish all of you the best of the rest of this year. Let me also point out to you that coming up next is Dr. Detlef Hollerman, who's going to talk about the energy market in a whole lot more detail. You need to remember to push the maroon button on there to join the next session to take advantage of his presentation. Thank you very much, and we look forward to seeing you all in San Antonio next year.